Let's dig deeper into those numbers. David Ohana is the Group Managing Director at KenolKobil. He joins me now live in our studios. Mr. Ohana, let's start with net cash from operations. That was down to about $2.4 billion from 2.4 billion shillings from 7.9 billion in the first half of 2014. What happened there? Walk us through the numbers.
Yeah, last year, good evening. Last year we had a one-off event, which is an OTS tender that we won and oil marketers paid. It's just a timing issue how you book. Our cash flow actually improved by almost $1 billion this year if you eliminate that one-off event.
Indeed. Revenue also down 19.2% compared to the first half of 2014, despite sales volumes, as I mentioned, going up. Where exactly was the hit? What product lines were badly affected? It's
actually across the barrel. Remember, oil prices crashed actually in January 2015. The crash started slightly even earlier in December. So we started there on very low level, around $45 per barrel. So that's what impacted the revenues. But all product costs came down dramatically.
Indeed. You also did manage to cut financing costs quite a bit, down 43.4% in the first half of 2014. How was this achieved?
Yeah, you know, we just disciplined ourselves. Even as of today, every day we pay back our loans to the banks. You know, it's just discipline. We started with the dollars last year. This year we went aggressively into the Kenya shilling, and we reduced it, as you can see, by 1.4 in the 6 months, 1.4 billion.
Indeed. You still have about 8 billion shillings worth of debt on your books at the moment. Is that all shilling denominated, or what's the split between dollar denominated debt and Kenya shilling debt?
Yeah, currently we are at 3 billion Kenya shilling, and we keep paying. I believe we'll close the year with the 2 billion, and then the other 2 will be smashed by I think that by the end of first half 2016.
Right. Walk us through the overall environment, though, because we're seeing the central bank raising retail rates, the Kenya Bankers Reference Rate, the CBR has gone up. How will that affect your operations in terms of your finance costs?
Look, definitely it's cold out there. You know, the results are good, but we are all, as an oil industry and all importers are struggling. But, you know, if you manage your inventory well, you don't overstock, I think it's manageable.
Indeed. We'll come back to that in that moment. I know it's not KK's policy to have any hedges in place. So how do you manage your currency exposure across the countries you operate in, especially at a time when the dollar is just getting stronger and stronger and stronger?
Correct. And I think this trend will continue. We just manage the inflows of dollars versus the liabilities in dollars. We try to balance. So long you balance it, you'll be hit not in a strong way. Again, there is no securities against that. It's just the hedges. Remember what we did in 2012. It went sour, and we know the results, almost 6.4 billion loss. So we don't want to go there. The board policy is to do a natural hedge.
Indeed. Let's focus on what you said in the statement coming out of the results. Management, you said, plans to focus more on high-yield business segments. What exactly are those?
Yeah, predominantly they are the non-fuel, LPG and lubricants, and relying heavily on our network. Remember, we have in East Central Africa, we have above 450 service stations. You know, the margins are lying there in the assets. So we are focusing, we are developing our networks in Kenya and in the region.
Indeed. One final question for you with regard to inventory. Across the industry, no one exactly saw this oil price crash coming along. So what's the current status of inventory management for the sector as a whole?
Look, the main driver, the main engine for the results of the first 6 months for us, for KenolKobil, was a strict management of the inventory. The inventory was the name of the game. That's what led us to make this 920 million. I know that the market is oversupplied. People in Kenya with a long position on stocks. In July, jet and diesel crashed by $70 per ton. Additional, as of today, the oil is crashing now 4%. It's additional $50 to $60. So yes, some people are in the cold. Luckily, myself and KenolKobil, we are in short position. So I think we are heading to, I'm not sure the same level of the second half, but a strong second half.
Indeed, we'll have to leave it there, unfortunately, for the time being. But thank you very much for your time,
Thank you very
Mr.
much.
Ohana.